I do have a variable life insurance policy. I did some research. It's not in BlackRock, but I'm wanting to get out of it. There is a surrender charge, but I was wanting to see if is there any other things that I need to worry about, as in if I want to close it out, that I need to look out for, or anything I need to look out for trying to close this out.
Yes, the first thing that you're going to want to consider is, do you have a need for life insurance? So, do you have someone who would need the income that you make, or the the financial resources that you provide should the Lord call you home before either of you were expecting?
Yes, and so what I want to do is to go to a term life insurance policy and get out of this one. And so that's kind of what I'm thinking of doing.
Okay. And you have no real health issues that would prevent you from doing that?
Yes, no real health issues.
Okay. So that's the first question. And as long as I would not even consider canceling it until you get some other coverage in place to take care of those that you could potentially leave behind before you were expecting. So get them taken care of. Then it just really depends on what the surrender charge is. Are you going to give up a lot of money to get out of it? Are you close to the end of that surrender penalty where you could maybe get your other coverage in place and, just decrease what you're putting in? Because in those types of policies, and I had to just check and make sure you're in Texas. I am insurance licensed in Texas. So inside those kind of policies, they're unbundled policies, which means that the death benefit, the cash value, and the investment component are all unbundled. So if you were to see a dramatic decrease in the things that your cash value is invested in because of market volatility, you could be asked to put in more money just to keep that policy live, because it'll impact your cash value, or you could see it lapse altogether. So there is, to me, life insurance is not a good investment. It has a purpose in protecting, the people that you might leave behind prematurely, but there are other ways to do investments, and it sounds like that's what you're on the track for. So I would really take a look at that surrender penalty and see how badly it's going to impact you, and see if you can't find a way to maybe ease out of it over time rather than just doing it all at once.
Okay. So my surrender, I think it's 15 years. I'm 8 years into it, 7 years, I guess, right in the middle. And so it's a little less than 8%. So it is, I'm losing some money, but, I'm kind of weighing it, taking it out and then investing what I was putting in there in my Fidelity account, in that market, and just continue with the term. So, but I understand what you're saying. I need to have something else in play, and all that good stuff.
Yeah, so another thing that you could do is you could contact the insurance company and you can ask them to send you what's called an in-force illustration. And you can ask them to send you a couple of them. You could say, if I put no more money into this contract, show me what will happen and they're going to have to make some assumptions about what's going to happen in the market. So if you go this route, you'll have to do it. So this would be a way to kind of use the cash value that you've accumulated in there, like not give it up in a surrender penalty, but to use that cash value to continue to pay for the insurance that you have right now. So that in-force illustration is going to show you, if you put no more money into it, when is it going to lapse, because there's not enough cash value to pay for it. But you'll have to keep an eye, because that's going to be variable and dependent on what the investments inside of it do. The other strategy is to say, okay, so if it shows that it would lapse in, let's just say, 3 years, basically you've used all of your cash value to pay for your insurance during those 3 years. If it says, well, you couldn't even go a year, then you could say, okay, well, show me what would happen if I just put in $50 instead of I don't know what you're doing, but $300 a month, and you can see what's going to happen there. So it's something that you would have to monitor, but it's a way to not just lose that 8%. And I don't know if the 8% is a lot of money, or if it's not. I don't know what the cash value is, but if it's a significant amount of money, then you may want to look at a more efficient way to use that cash value rather than just giving it to the insurance company.